Hello everyone. Welcome to RCD ShareNet. I'm Ella Huang. Today is the third and last session of a series of videos on the Registered Disability Savings Plan, RDSP. And today we'll be focusing on talking about tax implications and some new updates of RDSP. So the first one, on the same topic, we were talking about RDSP basics. And the second one was on maximizing your RDSP. Today we'll follow up on the same topic. There'll be some referral to the basics and how to maximize your RDSP. I won't be repeating the information, so if you're not sure about that, then I would suggest that you go back to view the other two videos to have the details. To start, I'd like to recap a few key points on the last two videos so that we are all on the same page. So RDSP is a long-term savings plan to help Canadians with disabilities to save for the future. So we've mentioned about this several times, and that is a very important point to keep in mind, because it affects the strategies of planning for your RDSP. And now it's, of course, how to maximize your RDSP is you can maximize your own contribution to get the maximum grants and bonds. So grants is the Canada Disability Savings Grant. I would just call it the grant. And the Canada Disability Savings Bond, I'll call it the bond. And how to get this, I've talked about that in the first two videos. And of course, in order to maximize that, you want to keep the money in your RDSP to the longest time. The longer you have, the better the return and the more of the amount of money you have contributed and received. And also the other thing about that is to, so that keep the money in the RDSP in order to avoid the 10-year repayment rule. So this we have already talked about in the second video, so go back there and have a look if you're not sure what it is. And we also mentioned if for some reason that own contribution is not possible, we can use the Carryforward to have the optimum unused grant entitlement. And lastly, if withdrawal is inevitable, that sometimes that is the reality that we need to withdraw from the RDSP, then make use of the proportional repayment rule and be aware of the assistance holdback amount. Okay, so that pretty much summarized what we did in the past two videos. Now we can go on to today's topic. So now after you have saved and then you try to maximize your RDSP. But at some point, maybe in reality, we need to withdraw from the RDSP. So, like withdrawal, what does withdrawal look like, from the RDSP? So one thing, and that is the critical thing, that only one person is allowed to receive money from the RDSP, which is the beneficiary. So if the beneficiary is the holder sometimes, and sometimes it's not the case. So if the beneficiary and the holders are two different people, then only the beneficiary is entitled to receive the payment from the RDSP, not the holder. Okay, so this is one thing that we need to remember. And basically when we withdraw from the RDSP, so the money coming out from the RDSP, there are two types. One is the Disability Assistance Payment, so we call it DAP, and the other one is Lifetime Disability Assistance Payment, LDAP. So what is the difference between these two types of payments? So DAP is actually subject to 10 years repayment rule and also proportional repayment rule as appropriate. So when you take out DAP, it is normally before the age of 60, and then you withdraw from your RDSP. So at that time, what you need to look at is actually the 10-year repayment rule. If you clear out everything of your own contribution or the amount that you're allowed to take, and then the government will take back the grant and the bond portion, so that may subject to the 10-year repayment rule. Or the proportional repayment rule, that is, you are not taking the full amount out from the RDSP. So you remember the $1, if you take out, then the government will, we need to repay the government for the $3 based on the proportional repayment rule up to the amount of the assistance holdback amount. So for lifetime disability assistance payment, LDAP, it is actually a mandatory payment from the RDSP when the beneficiary turns 60. So that is very important to know that. Once the beneficiary turns 60, then he or she must withdraw from the RDSP. How much? So that can be a regular withdrawal or at least once a year withdrawal. So that can happen just one time in a year, or you can do it regularly every month, depending on the decision. Until the RDSP has exhausted, or that means it's closed, or the beneficiary dies. So there are the two types of payment that you need to know from the RDSP. So when payments are received from the RDSP by the beneficiary, now it may have some impacts on the life of the beneficiary. The number one thing people may think of is the impact on the federal and provincial government benefits. And this is applicable for both types of the withdrawal. So it is very important to realize that the withdrawal, the money paid out from the RDSP, it doesn't matter what amount and how the composition is, it will not affect the eligibility for federal benefits, such as the Canada Child Tax Benefit, the Sales Tax Credit, Old Age Security, and the Employment Insurance Benefit. If the beneficiary at the moment in time has the payout from the RDSP, maybe it is the DAP or LDAP, it doesn't consider, as an income that would affect the government benefits. So when you report your income tax, which will be used to determine the receipt of all those benefits, it is not included in that. So that is a good thing to know. So it doesn't matter what is the amount coming out, it will not affect the federal benefit. And in British Columbia, the provincial government has announced a full exemption of RDSP payment to the beneficiary as the income and assets for the purposes of accessing the provincial benefits. So basically is to access the provincial disability benefits. In BC, it's called the PWD designation. So when people apply for it, then they look at the income and the asset level. And it's also an important factor for the recipients currently receiving the disability benefits. And the year when the payment received from the RDSP by the beneficiary, so when it comes out, it will not be considered as asset and will not be considered as income. So it doesn't affect the provincial disability benefits at all. So that is a good thing to know. So here is specifically talking about the impacts on government benefits, because later on we'll be talking about the tax implication, which is a little bit different. Now we know that there are DAP and the LDAP. How much can we receive? Can we just get any amount of money out from the RDSP at the time you need it? Unfortunately, that's not the case. So for DAP, which is normally happen before the age of 60, you can take the money out from the RDSP up to the assistance holdback amount, which is actually the total amount of the grants and bonds you receive from the government. And of course, minus the amount that you have already taken out. If you have not taken out anything, that is the full amount of the grants and bonds. So that means it follows the 10-year sorry, it might be the 10-year repayment route, but it's most likely is the proportional repayment route. So, they will look at that, then you can take out the money. But if you receive grants and bond in the 10 preceding years, then you're not able to take that, which is equivalent to the assistance holdback amount. For LDAP, normally there are two situations. So LDAP happens at the year the beneficiary turns 60. And at that moment in time, there may be two situations. One is the amount of contribution is more than the amount of the grants and bond from the government. Then the second situation is the reverse, that the amount of own contribution is less. So if it is less, in that case, it is called a primarily government-assisted plan. If it is not, then it is non-primarily government-assisted plan. The reason that we need to know about these two different types of plans because it does govern the amount of money that can be paid out from the RDSP for the lifetime disability assistance payment. Because that is a formula, so I'm not going to go into explanation of how they come up with the formula, how you calculate that, because everybody is subjected to the same formula one way or the other when you turn 60. But if it is, like the government-assisted plan, because the government's bonds and grants, they are a higher amount than your own contribution, they use the formula to calculate, and you need to follow that. So they actually control the amount of money that can be paid out from the RDSP in that way. If not, then if your own contribution is higher, then you're actually not subjected to that formula. Then you can plan your own payout from the RDSP. However, it is not as simple as that because although it doesn't affect the government benefits, it has some tax implications. So when we do that, how much money to take out from the RDSP is actually, it depends on the moment of taking the money out, what is the tax situation of the beneficiary. So what are the tax implications? So this is applicable for both types of the payment out from the RDSP, the DAP and LDAP. So when we look at the composition of the money in the RDSP, so that is own contribution. The own contribution, because RDSP is not a tax shelter, it is not tax deductible for the income tax purpose because tax has already been paid from the own contribution. How about earnings from the RDSP? So you do investment and then hopefully there will be capital gains. So there are different types of profits from that. That may be dividends, capital gains, and then all sorts of different profits. So as long as the earnings are remaining in the RDSP, it is tax-free. So year to year, you don't need to pay tax. However, when you take it out, that's another story. You need to pay tax on the investment gain. And how about the grants and bonds from the government? So when you withdraw the money from the interest, the grants and the bonds, they are taxed. So you need to pay tax on this amount. But at that time, they only look at the income tax rate of the beneficiary. So at the age of 60, if the person is not working and no income, so the income tax rate is pretty low, so that they may not need to pay a lot of taxes on their withdrawal. So when that happens is the RDSP issuers, so mostly they are banks or the credit unions, and they report the taxable portions of the payment to the government, and they will send out a T4A slips. So, if you have done a withdrawal from the RDSP, then every year at the tax season, you will receive the T4A slips, and then you need to report that in your tax return. So sometimes people are confused. Oh, you just say that it is not considered as an income. How come we have to pay tax on that? So we need to look at that. There are actually two different regards in this one. One, the income is not considered as income when you apply for the benefits from the provincial side. But in the tax side, you need to report it as an income so that it is subject to taxation. So there are actually two different sides of that. So I hope it is clear, for everyone to understand that, like when we look at that, so we need to focus on different things when we are looking at that. So we cannot just generally say that, oh, it is not an income, then you don't need to report it for tax. That is not the case. So I remember in the first series I mentioned that the RDSP was established in 2008. Since then, the government has looked at RDSP, so they are doing different updates to make changes. I think the process is pretty, continuous. Once they see that there's a need, maybe to address a certain issues, or there's some loophole somewhere, they want to resolve that, so they will introduce new updates. So now I'm going to tell you a little bit about the update summaries happened after the establishment of the RDSP. So since the RDSP, in 2008, in January 2011, the government introduced Carryforward. So for more information on Carryforward, you can look at the second episode of the series that we talked about that already. And in June 2011, they introduced something called Specified Year and Specified Disability Savings Plan. So what is this for? This is mainly for people who have a shortened life expectancy of the beneficiary. So if the beneficiary received the advice of the healthcare professionals that the life expectancy is 5 years or less, they're actually able to withdraw from the RDSP to a maximum of $10,000 a year without actually required to do the repayment to the government of the grants and the bonds that came into the RDSP in the preceding 10 years. So they actually lifted that repayment rule. If someone that have been verified by a healthcare professional that the life expectancy is 5 years or less, then they can start taking money out from the RDSP without triggering the repayment rule. So this is actually a good thing. And because when the life expectancy is shorter, the beneficiary may not be able to take out all the money from the RDSP. And then that may trigger the repayment rule, then that would lose the grants and bonds from the 10 preceding years. So in this way, there is no such implication. And then, so in that case, the disability savings plan will be that the individual needs to apply and to make the RDSP into a specified disability savings plan. So there are some guidelines in that. Once you have turned the RDSP into a specified disability savings plan, so it remains as a registered savings plan, but there is no contribution allowed, then the government will not pay in any grant and bonds. There's no carry forward of the unused grant entitlement and the bond entitlement, and there is no rollover of the education savings or the other types of registered savings plan. So once you have applied to be a specified disability saving plans, everything will remain status quo. So that is no more addition of the contribution for that. So I mentioned about the rollover. So in fact, in July 2011, the federal government proposed the rollover the year before, and then it became effective in July 2011. So what is the rollover? Mainly, there are two types of rollovers. One is transferring from a retirement savings to an RDSP. So since July 2011, a parent or grandparent of a financially dependent child or grandchild with a disability, they can arrange to have a portion or all of their retirement savings to be transferred to the child's RDSP when they pass away. So they can make that arrangement. When they pass away, if there are unused retirement savings, it can be transferred to the child's RDSP. And the good thing of that is it is tax-free transfer. Because we all know that if taking money out from the RRSP, you need to pay tax when you take it out. So in this case, because the RRSP holder passed away, and then that is unused retirement funds in the RRSP, so it can be transferred tax-free to the child's RDSP. So what types of registered savings plans are eligible to do this rollover? So there are only few types. One is the registered retirement savings plan. One is the registered retirement income fund or registered pension plan. So the unused fund in these plans can be transferred tax-free. The maximum amount of money to be transferred, so sometimes maybe that's why sometimes it's only applicable to some of the plan, not all, because that is a cap of that. It is the contribution of $200,000. And with the incoming of this rollover of the registered savings plan, the government will not pay matching grants on that, on the money transfer. So there are few, catches with that. And also the other thing need to remember is when the money rolled over into the RDSP, it also uses up the own contribution room. So remember we mentioned that the lifetime contribution room for the RDSP is $200,000. So if that amount is taken up by the rollover, then there is no more room for the person to put money into the RDSP. So that is something to consider, because without that, it will not trigger the grants coming into the RDSP. So for long-term planning, sometimes that we need to kind of look at that, see whether it is a good arrangement. And the other transfer is from the RESP to the RDSP. So the obvious thing is the beneficiaries must be the same person. Because for the registered education savings plan, that is for the child, and then the RDSP for the beneficiary, it is the same person. Then you can look at transferring the RESP to the RDSP. And then, of course, when they do that, then the beneficiaries' requirement of the age and the residency for the RDSP contribution is still standing. And the RDSP, not the entire can be rolled over. It's actually only the investment gain from that, because RESP, the contributor is they call the subscriber, usually is the parent. So if someone decide to transfer, to roll over RESP into RDSP, the own contribution will go back to the subscriber. And the grant and bonds from the government will go back to the government. So the only amount that will be rolled over is actually the profit from the investment. And then so we continue with the updates of the RDSP after talking about the rollover. So in 2013, then people start looking at taking some money out from the RDSP. So then the government introduced the tax withholding at source. So what does that mean? It's when you withdraw from the RDSP, money coming out from the RDSP, including the gain, the rollover amount, the grants and the bonds, they need to pay tax. So if your payment includes all this, then those are taxable. The only thing that is not taxable from coming out from the RDSP is own contribution. As we mentioned, it is after tax already. So at that time, RDSP issuers, when upon a request for withdrawal, they will withhold the tax at source. So for that, they will not kind of just go and do it. This is a little bit of the tricky part. So the RDSP issuers will base on two non-refundable tax credit to decide whether they need to withhold tax. So one is the basic personal amount. So we all have a basic tax exemption. And the other one is the disability amount, which is, if the individual is eligible for disability tax credit, they claim the disability amounts on their income tax. So either of these, if that is they have exceeded the total of these two amounts, that means the individual, the beneficiary taking the money out from the RDSP may be liable to pay tax. But if the amount of taking the money out is less than the total of these two amounts, that means they probably no need to pay tax. So in that case, they may not withhold the tax at source. Okay, we'll continue with the update of the RDSP. In January 2014, the government introduced the proportional repayment rule, which we talked about on the last episode. And then in also the same month, they also introduced, so if the beneficiaries lose DTC eligibility, they can elect to postpone closing of the RDSP for 1 to 4 years. What it means is, normally when the DTC becomes invalid, and then the RDSP needs to collapse. However, the government in 2014, they introduced this guideline so that the beneficiary can apply. So they use the word election. They can apply to postpone closing the RDSP, so up to 4 years. So because that allowed time for the individual to reapply again or become eligible again. But at that time, if the DTC cannot be renewed in 4 years' time, that it has to close in the 5th year. So in 2021, so this year, they actually have another updates on RDSP. It is to remove the time limitation for the RDSP to remain open. So that means, they don't need to worry about that it has to close in 4 years. So they just remove that time limit. If the elections apply, then they can keep the RDSP open. But during that time, of course, then the individual will not be able to receive any grants and bonds or make contribution. And this will all become available when the DTC is renewed. So basically, that is the essence of RDSP. It sounds a little bit complicated because it is a long process. We're talking about, putting money in, planning to maximize the RDSP and taking money out. So last thing I want to talk about is RDSP closure. So there are different conditions under which the RDSP has to close. So the RDSP, to close is, so if the beneficiary dies, so that is no beneficiary, then they have to close it. And so, or the RDSP has to close is when they still have the RDSP ongoing, but then they withdraw all the money that can be withdrawn. And then what's left in the RDSP is the assistant holdback amount, which the government will take back. So in that case, that is nothing in that. And then the plan, the beneficiary or the holder decides to close the plan. So it comes to the little bit I want to mention before we conclude is what happens if the beneficiary dies. So number one is to close the RDSP. And then what is if the money has not been taken out, then what will happen to that? So if the person dies in a specific year, and then the RDSP still has all the money. Then it depending on whether that is the 10-year repayment rule. If they have grants and bonds that that came in the 10 preceding years, and those amount will be repaid back to the government. Then that's the tricky part. That all the remaining, there's own contribution and the investment profit, they will go into the beneficiary's estate. At the end of the year, the beneficiary dies. So that is important to realize. Sometimes, like the money is put in by the family and they will not be able to take it back, because when the beneficiary dies, the whole amount that will come out from the RDSP minus the amount that returned to the government, they will go into the beneficiary's estate. So you cannot say that, I want to take my portion back by the family member. It doesn't happen like that. So in that case, we always ask, is there a will in place? So if the person has a RDSP, it is better to have a will in place, just in case things turn to the bad way. So right now, all ShareNet sessions on the RDSP have concluded. I hope the information is useful. We'll present the RDSP in Chinese in August, so stay tuned for that. Thank you for watching.